Welcome, everybody. This is Scott Gillum, your instructor today for lesson number 7, the Greeks and their role with your option trading. And we're going to talk about what's called visual Greeks. A lot of this will be done with this PowerPoint presentation, but I'm also going to bring up the Thinkorswim platform and go over the aspects of looking at a risk profile so that you understand what you're seeing. All right. So let me pull out the pen. Where is my pen? I got to get up my pen. I want my laser pointer. There we go. So before we begin to do anything else, I need to remind everybody all rights are reserved and copyrighted 2019 for ShadowTrader. That means the content in the presentation is presented for educational purposes only. It should not be considered as a recommendation to buy or sell the security. Therefore, information is in no way considered as investment advice. Trading options involves risks and may not be suitable for all investors. All rights and obligations of your option instruments should be fully understood before you enter any trade. All right, today, lesson 7, Greeks and our options. We're going to review the Greeks on the top of the presentation. We're going to talk about the underlying price correlation. That means stock moves by $1, what do my options do? Stock moves by another $1, what do my options do? And what Greek do I look to give me that information? We're also going to do some math. If you don't like math, it's not that hard. It's just addition, subtraction, and a little multiplication. But it can give you the insight into valuing your option and what and where it could be in the future of a price move. Then we're going to talk about monitoring your trade by the Greeks, how you do it, how I do it, and what some trigger points are, or where should I take the trade off? Is it going the right way? Is it going the wrong way? All right. So let's do an overview and review of options. The option value. Typically, the stock price is going to tell us what that option is going to be valued at. You got a stock price of $100. I'm looking at a $100 strike. There's got to be at least a value to my option. Well, that's deemed first and foremost by the stock price itself. Then we put into a factor of how long does this option have until it dies. The next piece is how likely is this going to move from that 100 price to, let's say, 110, 120, 90, 85, or 80. That's volatility. That's implied volatility. If you remember back from earlier sessions, historic volatility, which most of the people that talk about volatility on TV are talking about the stock volatility. That's historic. How much did it change from day to day? It went up by 1%, 2%, down by 1%, down by 2%. That's the historic volatility. The other piece that they misuse, and they say implied volatility, for a lot of the people talking, that's only on options. That's the expected pricing of your option based upon a movement of the underlying. Then we've got interest rates, which don't factor in a lot nowadays, but they could and they have in the past. We've got dividends that are a factor in the option price. And foremost with that option valuation is what rung on that ladder are you, or what strike on that option chain are you looking at? This is also going to be part and parcel. As you can see, across from it is implied volatility. These two work together, because the further away that you are from the stock price with the strike, the implied volatility starts to do something kind of weird. Now, along with this option value, we can figure out what the option is going to be worth given any move. Delta, what is delta? Delta tells me how much my option price changes for a $1 move in the underlying equity. The gamma, this is the other part that we look at for option valuation. Delta is a derivative of the option value for the next $1 move in the stock. Now, what is gamma? Gamma is the second derivative of delta. Gamma is the read that we use that says, okay, you've gone $1. Now, how much is this delta going to change, and how much will my option change for the next dollar? That's what gamma is. So delta is the direction of the movement. Gamma is the gas to get that direction going to the next mile marker. Then we've got time to expiration. That Greek that we use there is theta. Now, what is theta? Theta is that extrinsic, or that extra value that's put on your option that is eaten away every day as you get closer and closer to expiration. So theta is you can think about it this way. Theta is the ice melting, or the ice cream melting in that car as it goes forward. As we get closer and closer to our destination in time, the ice cream is melting and melting and melting. There's not a lot of the ice cream left. We started out with a lot. That's a big extrinsic value. And as we got closer and closer, that theta, or that extrinsic value has been chipped away, and that's the result of theta. Vega. Well, I think of Vega in this aspect. Vega is let me give you the definition. Vega is how much this underlying issue could move from where it's at now to where it could be in the expiration period of that option, given the certain strike that you use. So this is the volatility, or the probability of it going from where it is today to where it becomes profitable for you at expiration. Think of this as the velocity that the car is moving down the road. The faster, or the higher the implied volatility, the faster the velocity, or the quicker it will get to that level of being profitable. So something with an implied volatility of 10 and one that's an implied volatility of 100, the 100 implied volatility will move faster to a level that makes you profitable, whereas the 10 takes a lot longer to get there. Hence, we look at time to expiration and implied volatility in an aspect of how much time do I buy for this implied volatility to affect my option value to the point where I'm profitable. This implied volatility also has another piece to it, and that's the uncertainty that comes about with earnings. Because what is unknown is still unknown, and an earnings event now makes that unknown to a known event, implied volatility typically ramps up as we enter into closer and closer and closer time frame to our earnings report. Therefore, we can use this to our advantage, and we can use it to the advantage after the effect of earnings. And the fact that this implied volatility crushes or declines, that means extrinsic value is sucked out of those options. So we can use this in a judicious manner of saying that 100 implied volatility into earnings is going to go down to, let's say, 50, then 40, then 30, and we can start to sell options as we go beyond that unknown event, which becomes known, and this implied volatility expansion of extrinsic value then starts to decline. We can put that extrinsic value money in our pockets. Interest rates, that Greek is rho, not a factor at this point in time, so we'll skip it. And dividends, those are absolutely dollar for dollar on the option value. Once we go beyond what's called ex-dividend date, that is taken out of the value of the option as well as the value of the stock price. So there's a review. Now, a note about the Greeks. Greeks are a derived value. They're calculated using the most recent or last price that an option traded at. It's an instantaneous calculation. They are expressions of the underlying exclamation expected change in an option's value based on each of the variables. That's delta, gamma, vega, and theta of that option pricing model. Be careful though, values displayed may not be accurately predicting the change in the option's price for the future. They may be skewed one way or the other. They may be miscalculated. They may be misrepresented by the pricing because of people wanting either to be in or out of the option that you're looking at. Now, here's the delta definition. I've already said this, but it's on paper now. The amount by which an option's value will change if the underlying equity moves by $1, the first dollar. If we have a positive delta value, this means we're going in a bullish direction. Negative, a bearish direction. The values of delta can go between 0 and +1 on the bullish side and 0 and -1 on the bearish side. I'll read the bottom part. Therefore, an increase in an equity's price creates an increase in the portfolio value for long calls. Long calls are always positive delta. Short puts are also always positive delta. Now, if you're short calls or long puts, you have a negative delta, and you're expecting that prices will drop. That means that the short call or the long put on an equity that has falling prices, that option of a short call, long put will increase in value based upon delta only. All right, gamma. As I said before, this is the second derivative of delta, or a derivative of delta, pardon me. It's a second derivative. It's a derivative of delta. This is the rate of change that delta is going to change, or the change by which delta is going to move, based upon the next dollar movement of the equity. First dollar delta, next dollar gamma. Gamma, that value of gamma is going to then be used to adjust delta. The other thing you need to know is gamma is the greatest for the strike price for an at-the-money option at any given series of expirations. For a given strike price, gamma decreases as you go further out in time, which means that the change of the next dollar by the underlying has less and less effect on delta as you go further and further out in time. Gamma is reaching its maximum at options expiration for the at-the-money option. If you ever want to watch how gamma affects an option, watch your option chains on expiration day for something like a Netflix or an Amazon option that's at the money. You're going to see that gamma figure in that option chain just absolutely crank from near zero to almost a +1. And you're going to watch delta just kind of get like a Mexican jumping bean, up and down and up and down and up and down and up and down, based upon that gamma pushing that delta figure. And as it says here, mathematically, it's the first derivative of delta. All right. Here's something. Gamma can give you an idea of the sensitivity of delta and how delta can change. You can use this information to expand your thoughts of, okay, the equity's gone up $1. Now, what if it goes up $2? What if it goes up $3? You can use gamma to adjust that delta, which then goes into the calculation for what's my option worth. Let's go on to theta. Theta measures the extrinsic value, the amount above and beyond the intrinsic value, or the real true foundational value of your option at the strike that you're looking at. That expanded, or that balloon, that air in the balloon, is the extrinsic value. And theta measures that amount of the premium that's on your option. If theta is negative, means that the option is going to lose, and in this example, 8 cents on a theta of negative 0.08 each and every day if the underlying equity doesn't move in price. If theta is a positive value, it's going to mean that the position will be gaining on a daily basis if the equity just remains stagnant. That's why bull puts are the one that we did on Lululemon, because we were not looking for the price to go down. We were looking for it to stay the same or even go up in price. If it stayed the same over time, that extrinsic value of the option that we sold is eroding, like that ice cream cone in the car. It's getting less and less and less. Well, we sold it to that person in the car for 55 cents on our Lulu. And we get to keep it all if it expires not at the strike price. All right? Theta decays extrinsic value of that option price, just as I said before. Short-term at-the-money options have the largest theta values. As you get shorter and shorter in time and closer to the price of the underlying, theta gets bigger and bigger and bigger, which means that your option is more at risk, less at risk, but worth more to you as a seller if done correctly. and the difference between the theta values of shorter term options near the money can be rather significant. Not for the faint of heart. Vega. This is implied volatility. Vega measures the impact of this implied volatility change. Now, Vega is shown to you in a value like 0.04. It's not 4-cent change. It's a change in the implied volatility based upon a 1% movement in the implied volatility from day to day. So 0.4 or 0.04 Vega means that if implied volatility changed by 1% from yesterday to today, you could see that 0.04 change in your option pricing on the extrinsic value only. It's the velocity gauge or the velocity Greek. If implied volatility increases, the extrinsic value of the options price will increase. So if implied volatility goes up, extrinsic value is pumped into the option price. So an increase in IV, they're pumping air into the balloon. If the implied volatility goes down, they're pulling air out of that balloon and they're reducing the extrinsic value. We can use this to our advantage on options, depending on what side of that curve that we're on for this implied volatility curve that we look at. The value of Vega taken from an option chain represents the amount by which, this is the definition, this is one you should read and read a couple of times. It's the amount by which the option's extrinsic value changes when implied volatility moves by plus or minus 1 percentage point. Vega is always positive for long options, which means that as implied volatility increases, the value of that long option increases also. Now, long options, long calls, long puts. Short options, Vega is negative for short calls and short puts. All right. Now, how do we determine the impact of these Greeks on your trade? This is one slide that you're going to want to look at. Well, here's the spiders, and this is old. I apologize, but it's old. This is the SPY. Priced out here at 129. Yeah, it's old because we're up around 290, right? But the example is still valid. So I've got a movement from yesterday to today. The stock went down. Pardon me. The SPY declined by 45 cents, as you can see here. It's at 129.29, down 45 cents for the day. That's down 0.35%. And my portfolio looks like this. I've got this iron condor that's on. So I've got something that's, let me change this, hold on, do a pointer option. I'm going to go to a pen. So I've got an option trade that's a bear call up here and a bull put, let's say, down in here. I want it to stay in between this level. And that's what this iron condor, which we don't do in this advisory, but that's what it's saying. I am short this option. I am long this option up here. I don't want it to go above this level. That's the bear call. We've talked about that. Now, the bull put. I am short this put, and I'm long this put down here. I don't want to have it go below this level. So I want it to stay within this range. I make money up here because this was done for credit. I make money down here because this was done for credit. And I want to erase all this. Hold on. I want to erase all. All right. So that's what this iron condor says. Underlying price 129.29. Wait a minute. 1750 down 25 cents or 2.5 cents. My change is a minus 1250 in percentages. How did I get that information? How did we figure that? And that's what we're going to go through right now. You can say I've got delta, I've got gamma, and I've got vega and theta to be used. 2.31 positive delta, a negative 6.47 negative gamma, which means that as the equity moves, this is the amount that is going to be changed in delta. Vega, how fast, how slow am I moving on this one? I'm a negative 10 on the Vega. And my theta, positive 3. If the stock stays the same, I pick up $3.11 each and every day. Well, today's gain was $12.50. So let's go through the calculations, how this positive $12.50 got into our valuation for our portfolio. All right. So here's the breakout. Here's the breakout of all the pieces. A 122 put long, a 123 put short down in here. We're short a 136 call up in here, and we're long a 137. Again, my short put, my short call. I'm bound between these two, about $14. To limit my risk, I bought the 122 puts. To limit my risk on the call side, I bought the 137 calls. So I'm $1 wide and $1 wide. But the stock can't be at both places at the same time. It can only be up here or down here. So let's take a look at how we calculate this $12.50 profit that we had today. All right, that's our market gain for the day. Our delta is $2.31 delta, which means every time the stock moves up, my delta is going to increase the value by 2.31 cents. So I had a 45-cent decline in the price of the underlying, the SPY, times a 2.31 delta gives me a loss of $1.04. All right, wait a minute. I've got $12.50 of profit. So something else comes into effect here. All right. So now I've got theta. Right? If the equity stays flat, I make $3.11 for the day. Well, one day, I pick up $3.11. Now, how about my implied volatility? My implied volatility is a minus 10.5. What did it change? Well, the only way to tell that is to go down. Where's my little cursor? Hold on. I lost my cursor. There we go. The only way to tell that is to go, what's the difference between this day? Let me put the pen back on. Where was I at yesterday? Right there. And where am I at today? Right there. All right, the movement from yesterday to today was a negative 0.9933%, or almost a 1% decline in the implied volatility. It went from 20 to 19. So that times a negative 10.5 Vega actually gives me the positive $10.43. So I'm losing $1.04 because of the decline in price. That's the delta impact. I'm gaining $3.11 on the theta. And this is net theta, by the way. The theta aspect of it eroding every day, that ice cream cone. Plus, I'm picking up $10.43 in profit or portfolio value from the Vega change, 1% change, giving me that net $12.50. This is how you can evaluate any of your spread trades. Take your delta impact, change in the price for the day, take your theta value that's shown in the chart, take your Vega valuation, multiply it by the change in implied volatility one day to the next. You can estimate this. It can be done from a chart. It can be done from a ThinkScript study. But that will give you a validation of the change in your market gain or loss on your trade. Okay. Now, let's go back to Think or Swim. Pull this up. Let's go max. Let's go and analyze the trade. Let's take a look at this proposed American Airlines trade that I've got on here. All right, I don't like this one, so let's just cancel this. All right, let's do Adobe. Let's go back and do Adobe. Okay. Adobe, we know they have earnings out in the future. So let's take a look. We talked about doing a 290 or 295 to 300. Let's take a look. Let's say that we put this on back here a week ago. I'm going to assume we put it on a week ago. I will show you how you can kind of back test this on a not the greatest of basis, but we can back test it. So the prices were about the same. So let's take a look at a November 15. Let's do a 285 vertical with a 290 as our value, or as our short side. Change this to 1. So we're buying a 285, we're selling a 290. Let's say we did that for $2, or pardon me, $1.92. Okay, November 15. I'm going to change this back a week. I'm going to go back from today back to last Monday. I'm going to show you my risk profile. This goes out to November 15, so I've got to set that for expiration. Set my slices. And let's say that today's price is the same as the price that we got in. You know, the stock is still around 279. And that is kind of about the same. 279, 279. So it's not a stretch. We paid $1.90 for this a week ago because the market wasn't as bullish. Our implied volatility here on the 15th is 28.29. So we're 28 implied volatility. So if we think, let's say we go forward in time, all right, we need to kind of evaluate, are we making money or are we not? So on this trade, as we start this out, our break even is up here at 286.87. Our current price is here at 279, back on the 7th of October. Are we going to make money if this thing stays the same? Here's where the visual Greeks come into view. Green line is expiration valuations. So if the stock stays where it is, we lose $190. If it goes to our break-even point of 286.90, we don't make any money, but we don't lose any money. If it goes at or above our 290, we make all of the money that we can, as long as we're before the expiration date. That's how you read this green line. The purple line, this can be read as your delta curve, can also be used as your theta valuation. If this line is tipping higher from lower left to upper right, you're in a positive delta situation. Right there, positive 8 delta. So every dollar that goes into increasing the stock price, we gain on this line. So we go here, we go here, we go here, we go here. The values get higher and higher and higher on this current option spread valuation line, which is the pink one. All right, that's delta. Theta. Remember, theta is the extrinsic value that erodes day after day after day. If we're above the green line, which is expiration, this pink line wants to go to green. It always wants to go to green. So if we're up here and we go down here, we have something going down. That means theta is negative. If we're over here, pink line wants to go to green. We are going up. Our theta is positive. Our theta is positive. Let me show you the other example that we have already going on, and that's our Lululemon trade. So let me pull that up. Lululemon. We sold a put and we bought one lower. We sold it at 187.50, bought one at 185. I don't want the stock to go below 187.50. I don't have the unlimited funds, so I bought protection or insurance $2.50 below. So there's our 187.50 right down here. That's where I don't want the stock to go because I lose all my money. But what have we got going on with this one? Same type of positive lower left, upper right purple line as we had before, right? So we've got positive delta. But where are we on the value of the underlying? We're not over here like we were with that Adobe. We're on this side. So the purple line wants to go to the green line if the stock doesn't move. That means we're making money as we wait. Let's go back to Adobe. That Adobe trade. Okay. Now, we bought this a week ago. We're underwater right now. The value of this is not going to work if we don't have price movement higher. So let's say that the price moves in a week, moves to here. I'm going to assume it moves there. And we've now gone a week ahead. Today is the 15th. This purple line moved down. So we've lost some theta, or we've lost some extrinsic value. But we're further on this delta curve, and we're higher on delta. How much is it going to move if we go from 184 to 185? Well, it's going to be this delta figure, subtract the gamma from it, so our delta is going to actually go down by 0.09. Now watch. If I go from here, 83, let's do it by 84, we went down. See how the delta is going down? But what happens if we go to parity? Which means break even. Well, our delta is about 9 delta right now. Our theta has gone from minus 42 cents. Pardon me. I've got the wrong, why is this? Okay, that's what I want. All right, our opening price was here with a delta or a theta of a minus 152. But as we go to break even, our theta comes back to parity. Then we go bingo, positive on our theta as we move across this line to the other side. That means for every day that we wait, this line is going to go green and we've got positive theta. The slope of this purple line is your delta. The distance between where it's at today and the expiration line is your difference in theta. Are you going up for positive theta or are you going down for negative theta? Our Vega. Well, we can't adjust Vega on this chart, but let's say that this implied volatility goes from 26 and it goes to like 13. Well, our Vega is also going to then change the delta, it's going to change the valuation of our trade. So if we did this for today's trade, right? We bought back here, same price as it is today, but we go to today, this is back, if we did it back last week, that's our theta from the purchase, minus 1.04 with a delta of that. And if we go to today's valuation, no change in the stock, we're now a minus 2 theta. We're still here. And we're now a positive 10 because the line is getting steeper. We need this to go up. As it goes up, our delta, you'll see, is going to change minorly, but our theta, our extrinsic value that's in the trade, is going to then become positive, and we have the ability to have a positive return on our trade. Okay, so I'm going to put those two snapshots of the risk profile into today's PDF so that you have them to visually view along with the discussion. All right, any questions at all? All right, folks, thank you much. I'll end our presentation. I will put together the replay, send it out to you when I get it done. Thank you both, or all three of you that were here. Wish more of you would come to the webinars. It would be very nice. Thanks, Eric. Thanks, Carlos. Thanks, Gary. Bye-bye.